Credit, Lesson 5, Secured versus Unsecured Credit. In this lesson, you'll learn the difference between secured and unsecured debts, as well as the benefits and drawback of secured and unsecured credit cards. Loans and other types of financing typically fall into two main categories: secured and unsecured debt. The primary difference between the two is collateral, which is something of value that the lender can take if you were to stop making payments on the debt that you owe. A secured debt is when a borrower puts up some kind of asset as collateral for the loan. Home loans and auto loans are the most common types of secured debts. When you finance a house or a vehicle, it becomes the collateral for the financing. With an auto loan, if you fail to make the payments, the vehicle can get repossessed by the bank and then auctioned off. If you quit making payments on a home loan, the bank can seize the property and then sell it, which is known as a foreclosure. And you don't ever want either of those things to happen. Unsecured debts have no collateral backing. They're based purely on your credit worthiness and then your promise to repay. Examples of an unsecured debt are things like personal loans, medical bills, credit card balances, or installment contracts where you agree to pay for a specific length of time for a service, such as a gym membership or a product that you get now and pay later. If you just stop paying your bill, the company doesn't have anything tangible to repossess. Unsecured loans are debts that typically come with higher interest rates than a secured loan because they're taking a higher risk by lending you money without a guaranteed way of ever getting it back. If you do default on an unsecured debt, the lender can send you to collections or initiate a lawsuit to collect the money that you owe. There are two types of credit cards: secured and unsecured. The first one we're going to talk about is a secured credit card. If you have bad credit, or in your case, no credit, a secured credit card can help you build credit history. These cards are often advertised as guaranteed approval cards and don't have a minimum credit score requirement. You can apply for one when you're 18, and most lenders won't even check your credit. Once you're approved, you're going to make a one-time refundable deposit, and the amount that you deposit determines the credit card's limit. So for example, if you deposit $200, your limit is $200. Secured credit cards are a risk-free way for a lender to help you build your credit. In the event that you stop making the credit card payments, the lender can use your deposit to cover the money that you owe. However, you never want that to happen because it's viewed the same as defaulting on another loan or credit card. The lender will close your account and it'll be very damaging to your credit, so don't let that happen. With a secured credit card, you still need to make your payments on time each month. If you don't pay the balance in full, you're going to have to pay interest, and interest on a secured credit card is usually a lot higher than interest on an unsecured credit card. It can take anywhere from 6 to 12 months of making your payments on time to prove that you're responsible. Once you establish that trust with the lender, they typically refund your deposit and upgrade you to a regular unsecured credit card. In some cases, you might need to contact the lender and then ask them to upgrade it for you. It's important to know that not all secured credit card companies report to all three credit bureaus, which is kind of a big deal. If you get a secured credit card with the intent to improve your credit score, the lender needs to actually report that you're making your payments on time. So be sure to verify that before you apply. An unsecured credit card is the same thing as a regular credit card. Unsecured credit cards don't require any kind of deposit, and the application process always includes a credit check for approval. If you're approved, your credit limit and your interest rate will be determined based on your credit history. Unsecured credit cards typically have lower interest rates than secured credit cards, and then they come with fewer fees. Some of them even offer rewards programs like cash back or airline miles. We're not going to be going too in depth on those because when you're first getting started, you don't need to worry about rewards. We're going to go over how to actually use a credit card responsibly in Lesson 10. You just learned the difference between secured and unsecured debt, as well as the differences between secured and unsecured credit cards. In the next lesson, we're going to cover different approaches for getting your first credit card.